Global economic growth is slowing more than expected after Russia's invasion of Ukraine. That's according to the latest report from the Organization for Economic Cooperation and Development. It says soaring energy prices and record high inflation risk pushing major economies into recession. Now, the OECD has forecast a $2.8 trillion hit to the global economy next year, with Europe accounting for much of the decline. It downgraded the outlook for both the Eurozone and German economy and is forecasting zero growth for the UK in 2023.
We are facing a global and broad-based surge in inflation. Inflationary pressures were already building up during the recovery from the COVID-19 pandemic as economies reopened and supply couldn't match the sudden surge in demand. Russia's war of aggression against Ukraine brought additional disruptions to commodity markets and pushed prices on those markets up further.
Marco Valli is Chief European Economist at UniCredit in Milan. Marco, thanks very much indeed for joining us. First of all, is this directly related to the war and the energy crisis, or were we heading in that direction anyway?
Yeah, absolutely. The energy crisis is playing a big role here, and especially in Europe, right? But regardless energy, what we see is that the outlook provided by the ECB envisages much stronger inflation rates also in countries like the US, where actually the war has been less of a factor. So this means that you have underlying price pressure building up, and on top you have the effect of the war, including energy and food prices. So this leads to a global outlook where you have higher inflation, weaker growth, and much more aggressive central banks. And financing conditions are tightening quite aggressively, and this is why the OECD has revised down its growth forecast significantly, because you have higher inflation, tighter financial conditions, and that's not a good mix for future growth outlook.
The general picture from this report seems to be less than expected growth in 2022, but a real fall away in 2023 for quite a few countries, including the UK.
Yeah, no, absolutely. This is the key point. I mean, 2022 is still okay, right? Because we started the year on strong footing in general, and then the loss of momentum, the real loss of momentum, I think it's starting now, started after the summer, and will continue through the winter months, especially here in Europe, where I think it's very, very likely that most countries will experience a technical recession, at least in the 2 quarters at the turn of the year. At least this is UniCredit forecast, right? If we look at the yearly average numbers provided by the ECB, we see that across the Eurozone, Germany seems to be the one that is more at risk of slipping into a recession. But I think other countries will do so, right? In general, I see that some growth numbers, especially here in Europe, tend to be maybe slightly too optimistic. I would probably think that they could be cut further, right? And you mentioned the UK. Obviously, in the UK, the situation is changing extremely rapidly. We have seen that there has been a very strong fiscal announcement on Friday. Markets have taken notice, a very, very big sell-off in gilts, strong downward pressure on the pound, and most likely much higher rates needed from the Bank of England. To me, this is a perfect mix for significant downward pressure on economic activity, and therefore the outlook for the UK economy is becoming darker by the day.
So, Marco, a lot of the political language is focusing on these difficult times, we will get through them, and politicians using the language of at some point we will return back to normal, suggesting that this is temporary. But do you think we've passed a point that we'll never see again? Do you think we're heading into a whole new way of governments running economics, and perhaps the good days are over permanently?
Well, I think we will enter a new equilibrium after COVID and after the war, where almost certainly there will be more government intervention in the economy. Okay, we can discuss whether this is good or bad, depending on how this is done, how this is pursued. You can have favorable implications, or if this is overdone, we can easily slip in a situation where business confidence is hit because you have too strong of a role play by the public hand. I also see significant discontinuity compared to the past in terms of supply chain activity. both COVID and the war have shown that the previous models, the pre-pandemic models of supply chains, is probably not going to work and not going to be replicated going forward. I think there will be a tendency to diversify suppliers, to shorten supply chains. It is not a coincidence that the economies, manufacturing economies that currently rely more on long and complex supply chains are the ones that are more under pressure. And this is the case, for example, of Germany. So supply chains will change definitely compared to before the pandemic. And all this has implications, I think, in terms of inflation rates we can expect going forward. Once the current jump will progressively fade, and expect that this will happen, we will probably settle at around inflation rates that will be higher compared to pre-COVID. How much higher? This, I think, is the big question mark and the big question that financial markets are really asking. My sense, my feeling is that it will be higher, but it will not be dramatically higher, right? And therefore, I think that the slowdown in inflation will gather traction over the course of 2023 globally, and by 2024, I think in most areas, price stability will be restored.
Marco Valli, Chief European Economist at UniCredit. Thanks very much indeed for joining us today.
Thank you. Thank you for having me.